Hello and welcome to another Wealth of Advice market update on the 18th of November 2022. Yesterday we had another budget delivered by Jeremy Hunt, and my colleague Matthew is going to run through the key points that came from that. There wasn't, I don't believe, a great deal in there, and all of it was pretty much leaked to the press in the days leading up to it. However, Matthew is going to go through those finer points in a second.
On Thursday, the new Chancellor Jeremy Hunt set out the government's plans for taxation and spending. Looking at the high-level figures, income tax will remain at the same rates, 20%, 40% and 45%. The previous announcement from Kwasi Kwarteng in the mini-budget that the additional rate tax of 45% was going to be scrapped, that's been cancelled. They have made a slight change to additional rate tax in the sense of it previously had a threshold of 150,000, that's being reduced to 125,000 and £140. For those people who are affected by this, they're essentially going to pay an extra £1,243 tax per annum. In relation to the personal allowance and the tax bands, they will remain frozen until April 28, which is 2 years longer than previously planned. As we see inflation and wage growth, that's essentially meaning that people will pay more tax as those bands are frozen. Looking at inheritance, the nil rate band, the 325,000, that will be frozen until April 28, and the same with the residential nil rate band of 175,000. We have seen a change in relation to dividend allowance. This is currently at £2,000 per annum and is going to be reduced to £1,000 in April 23, with a further reduction to £500 in April 24. Capital gains tax has also been reduced in the same way. It's currently at £12,300 per annum, and that's going to be reducing to £6,000 in April 23 and a further reduction to £3,000 in April 24. There were no tax allowance changes announced in relation to pensions. There was previously some expectation that there might be a change, but there wasn't anything in the budget. In relation to corporation tax, that will rise to 25% from April 23 as originally planned. However, small companies with profits below £50,000 will continue to pay at the current rate of 19%. Unlike the previous mini-budget, the announcements on Thursday haven't had a dramatic impact on the market. In relation to how it affects our clients, the main changes relate to the dividends and capital gains tax, which is relevant for people who have personal portfolios. When we are looking at your personal portfolios, we'll be having conversations about changes within the funds and any income that's being produced to see how the allowances are relevant for yourselves.
So what felt like was positive news regarding the war in Ukraine was the fact that the Ukrainians recently recaptured the city of Kherson, which put the Russians on the retreat. And obviously you're watching this news and you're hoping, does this mean the war will end in the next few weeks or few months? So on Tuesday night, a stray missile went across into Poland and killed 2 people. As a result of that, the markets were a bit jittery first thing Wednesday morning until it was revealed that it was actually a Ukrainian missile that had gone astray. So you can say that this war is still causing volatility in the markets, and markets are still worried that it's going to spill into other areas. That said, the Russians do look to be sort of weakening. China is not happy with what's going on with Russia. The recent G20 meeting kind of confirmed this. So it's definitely a very, very important consideration for world markets, what's going on in the war in Ukraine. When we look at interest rates, the Bank of England raised interest rates again by 0.75%. It was the largest single increase in 33 years as rates rose to 3%. Obviously, people looking at this news story think this is a negative story. For those people with variable rate mortgages, etc., it will be negative because it means you're going to be spending more money on a monthly basis on your mortgage bills. However, let's remember that long-term interest rates should not be 0 or 0.25% or even negative. Interest rates between 3 to 5% is what the long-term historical average of interest rates have always been. So if anything, we're getting interest rates back to where they should be. So that definitely is a good thing. It means that in future years, if the UK economy gets into difficulty, you've got another lever you can pull to try and reduce rates to stimulate growth. So if anything, we should be looking at interest rates as a long-term positive that they're going up. Obviously, we don't want to see them go too high. The reason why they're raising interest rates at the moment is to try and curb inflation. The inflation figures that came out on Wednesday were the highest in 40 years, so therefore it's reasonable to expect that interest rates will go up again, maybe next time the Bank of England meet in December, or they may wait until January or February to see how the impact of the recent rate rises have had on the economy, because obviously it doesn't happen as quick as you might expect, where an interest rate rise in September automatically reduces the inflation rate the month after. Obviously inflation being as high as it is, 11.1% I think it was yesterday, the highest since 1981. The main factors that are causing inflation to be so high is the cost of food and the cost of energy. Energy prices are coming down, wholesale gas, wholesale oil prices are coming down. That's good. Food prices going through the roof, so that's not good. But let's hope, as I say, that the rise in interest rates does mean that inflation comes down in the not too distant future. We mentioned mortgages and interest rates. There is a potential mortgage time bomb, which is again another scary headline. You can see from the chart we're putting on the screen now, just showing you when fixed rate mortgages come to an end. And how many people took out a fixed rate mortgage. The fact of the matter is more people in the UK take longer fixes than they've ever done in the past. If you look across in America, most people will take between a 10 or a 20-year fixed rate mortgage, whereas in the UK we talk about 2-year, 3-year, 5-year fixes. But there will be some potential problems if mortgage fixed rates come to an end and people leave these, go into a variable rate where the rates are much higher. If you look at long-term interest rate expectations, 2024, 2025, it is expected that interest rates will come back down slightly after we get through this inflation cycle that we're in at the moment. So when we look across to the US and what inflation's like over there, their inflation data for October came through at a positive rate of 7.7%. Anybody who watches stock markets on a daily basis like I do would have seen this news last Thursday, I think it was, on the 10th of November, when the S&P 500 jumped over 5%, I think it was, and it was the best one-day return on the S&P since April 2020, obviously after the COVID drops that we saw there. The US Federal Reserve had raised interest rates by 0.75%, which was expected by investors, and as I say, markets expected that. However, we now think that because inflation has believed to be peaked in the US, that they're not going to be as aggressive in raising rates going forward. That's going to be positive for lots of reasons. When US was raising rates, it was making the dollar so much stronger. So the fact that they may not be raising rates as much now in the next cycle may mean that the dollar weakens and the pound can strengthen against that, which will be positive. We've put a breakdown of US inflation on the screen right now, and again it's a similar picture to what we see here in the UK, where food and energy costs going up is the main parts of that. So if we look at what's going on in the war in Ukraine, that was what was blamed for food prices going up because of the wheat, etc., that's produced in Ukraine. Governments around the world need to do something about this. Again, the G20 meeting was on this week. You have to hope that some of the meetings that were held there will do lots of things to try and address this. And as I say, as we enter 2023, you just would expect that these inflation figures start to come down, because obviously inflation is a 12-month calculation of where prices were 12 months ago from today to what they are now. So as we keep moving forward, as prices have gone up, you've got to believe that those inflation figures will come down. When they get them back down to the 2.5-3% long-term target, who knows? Bank of England and the Federal Reserve would like that to happen by 2024. It may be longer than that, but let's keep watching and see what happens. We recently attended an investment seminar where the topic of interest rates came up. As we've said on the presentation, the Federal Reserve in America has been very aggressive in rising its interest rates this year. The Bank of England, as we all know, has been raising our rates, not quite to the aggressive levels that the US have. However, people are fearing that interest rates are going to go really, really high. The graph that you can see on the screen right now shows that when inflation is believed to have peaked, how many months after that before interest rates will start to be cut. And it's quite interesting. If you look at the previous sort of 10 events of when interest rates have gone up, it's only been on average 5 months after the last rate rise before they start reducing rates again. And the fund manager we heard speak about this was therefore suggesting that we could see rates start to come down maybe February or March next year. Obviously, that was just a prediction given based on what's happened in the past. But the factor that he said would drive interest rates being cut would be if unemployment levels start to go up. And he was obviously believing that unemployment levels are starting to go up. And if you look at the data, that is starting to show through right now. So there is a good chance that rates could start to come down in 2023. Maybe not February, March, maybe a bit later, who knows. But if rates were to come down, markets would like that, and you would see a very positive response. Given how bond markets work, if interest rates were to fall, bond markets would like that as well as stock markets. So hopefully it'll be a win all round that rates will come down. Obviously, for that to happen, we need to see inflation peaked. Many people believe the inflation figures in America are showing that it's peaked, and as I've said earlier, in the UK, the inflation figures dominated by energy and food costs. Again, we're hoping that we're now over the worst of that as well. The next chart that you put on the screen, hopefully, is another one which provides you with some optimism as to what may be about to happen. And what it shows is how the S&P 500 has performed historically after a series of high inflation, once inflation is deemed to have spiked. And as you can see, let's all hope 2023 is like 1974, because 6 months after inflation peaked in 1974, the S&P 500 returned 42%. But then when you look at the other figures, 1980, 1990, and then 2008, the average return within 6 months of inflation peaking has been a 15% return on the S&P 500. And then if you look at what the 12-month figure is there, on average after an inflation peak, it can be 23% in that particular market. Obviously, the UK markets, European markets, Asian markets will all respond in a similar fashion, maybe not as strong as the S&P, which is dominated by some huge companies. But clearly, if inflation has peaked and starts to come down in the early part of 2023, and interest rates come down as well, then you should see very positive returns coming in 2023. And hopefully these poor returns of 2022 will soon be well behind us. So across in America, we recently had the US midterm elections. Historically, that's never been good for the incumbent president. However, this time around, that wasn't the case. The Democrats did very well. Mr. Trump has been blamed for the Republican Party doing so badly, which is another matter altogether. He's subsequently announced that he is going to run for presidency in 2024. But the Democrats are feeling very confident right now with the results that they've had. What I'm more bothered about is if you look at the chart, you can see that the year after a midterm election, the average investment return on the S&P 500 is around about 18.6%. So let's hope history repeats itself and we have a very positive 2023. So this, coupled with hopefully interest rates going down, hopefully inflation peaking, should mean 2023 is a lot better than 2022. So we now come to that part of the presentation where we look at how stock markets have performed. This time we're going to look more at the short term as well as the long term, but the short term is very interesting. The graph that you see on the screen right now shows stock market performance over the last 3 months. And as you can see, from the end of the middle of August, all the way down to the middle of October, markets had a quite torrid time. Most major markets were down between 7 to 10%, which certainly wasn't good. We're sitting having client annual review meetings, and you're looking at 12-month returns for clients, and some people in some of the moderately speculative portfolios, for example, were down well in excess of 10% over that 12-month period. And even some of the more cautious portfolios were down, because there's not just stock markets that had fallen over that period, it was the return on government and corporate bonds as well. Then, as I say, if you look at the graph from around about the 12th of October onwards, you can see that there has been a bit of a rally there, and certainly in the last few days, the 5.5% growth in the S&P that was seen last week has certainly helped boost returns back up. The next graph shows what market performance has been like over 12 months. I spoke with one client yesterday, showed this particular graph to them, and he quite rightly described it as a roller coaster. I'm not a huge fan of fast roller coasters that go upside down and all around, and that's certainly what that looked like. I think that would frighten the life out of anyone if you were riding that up and down, and that's certainly what it's felt like over the last 12 months. And if you look at the cycles over the last 12 months, you can see there's been like a couple of month blocks where you get serious downs. Markets reach a low point, people think this is cheap market to buy, and markets will come back up. So again, to reassure clients, about how far can things fall. There always comes a level where markets get to where big investors will think, right, these are opportunities to start buying shares. You look at the middle of June into July there, when markets really lurched low, and you saw big stocks like Amazon, Apple, Microsoft, these sorts of huge stocks were trading really low. And certain investors thought, well, now is an opportunity to buy. Stock market's going down because everyone's selling the market, but then all of a sudden investors will look at one company and think, that's a cheap opportunity, let's buy that, and it will come back up. And that obviously boosts the market. And you can see there in the recent weeks how the markets have come back up there. The FTSE 100 is still the top dog on that list, mainly buoyed by what's gone on with the oil and gas sector. Obviously BP and Shell listed on the UK stock market. S&P 500 still negative over that 12-month period, but is coming back. And then the MSCI World Index is the one that lags most behind. Now we look at it over 3 years. Go back to what we've discussed many times previously, Brexit, COVID, etc., has meant that the UK market is the worst performer over that period, but it is in positive territory over a 3-year period. But the S&P 500, the biggest companies in the world, dominates, and as I say, I think that's going to be the theme going forward as well. As ever, if you invested for the long term, you will get returns over that period, over the longer term, whereas the shorter term volatility has been quite severe. The graph that you can see on the screen right now shows the VIX Index. We put this up all the time to show where volatility looks, and as you can see, in the last few weeks, the VIX Index has come right the way down. It did spike a little bit on Tuesday, Wednesday, when this stray missile went into Poland from Ukraine, but then come back down again slightly. But it's good to see that the VIX Index is well below 30. I think it was down to 24, you can see on the screen there. So we're very happy that volatility seems to be reducing now as we come to the end of the year. And hopefully, as I say, 2023 is more positive. So thanks again for listening to another Wealth of Advice market update. Hopefully, as we come to the end of this pretty crappy year of 2022, there's been a few bits that we've put in there today which gives us optimism for what 2023 may look like. As ever, if anyone has any questions, queries, or wants to get in touch, please do so through the usual channels, email, telephone, through the app, ring your advisor, ring me. But hopefully everyone is feeling more reassured after watching this. Thank you.